I'm Rob. I'm an investment counselor and a member of the multi-asset team here at Orbis. And my talk for you today is called This Could Take a While. Now, before I get to the fun stuff, just really 2 minutes about who we are for those who aren't familiar. Orbis has been investing globally since 1990. We currently manage about 25 billion pounds worldwide on behalf of our clients. We describe the way we invest as long-term, fundamental, and contrarian. By long-term, we mean we take a very long view of history and a long view of companies' futures when we're making investment decisions. By fundamental, what we mean is we care about what businesses are worth as a business owner. We care about valuation, almost intellectual cousins with a value approach. And we mean we go around the world company by company, building our portfolios from the bottom up. By contrarian, we mean we are willing to be incredibly different from our peers and from our benchmarks when our research tells us that we should be. Now, in the UK, we offer a focused range of just 3 strategies across the risk spectrum. In the middle is our global balance strategy, which you can see here is celebrating its 10-year anniversary this year. So we're very pleased to be celebrating 10 years with the strategy. The portfolio manager actually recorded a great interview with Maren Somerset Webb that's on our website for the birthday occasion. And much more importantly, we're pleased that over those 10 years, we've delivered good returns for clients. So if you look at our rankings now, our balanced fund is #1 in the peer group over the last 1 and 3 years. And much more importantly to us, it's #1 in the peer group over the last 10 years, because it is that long-term performance that we care about. So that's enough about us. I have some learning objectives here today. I hope this is going to be educational for you. Really, I want to talk about what happens when bubbles crash and what do cycles look like? What's a simple way that we can understand cycles in financial markets and in the real economy? So we're going to try to identify about how long it takes for bubbles to burst. We're going to talk about how markets can affect the real world, and particularly inflation. And then I'm going to spend a bit of time talking about how bubbles affect not just the overall level of asset prices, but valuations within asset classes. So let's start off with things that are familiar to all of us, things we already know, and things that Dan mentioned in the opening. We all know 2022 was a rough year for stocks. Global stock markets were down 18%. That was their worst year since the global financial crisis. The more surprising thing, and this wasn't supposed to happen, right? People were banking on this not happening. Bonds were down too, right? Bonds, depending on which metric you look at, were down 17% in 2022. They did not counterbalance stocks. Depending on the metric you look at, that's their worst performance in over a century. Now, if you combine one bad return with another bad return, what you get for the classic 60-40 mix of stocks and bonds was a terrible year in 2022, down 18%, the worst year since the global financial crisis, the second worst year in the last 3 decades. Now, after all that pain, we can understand why lots of investors would be anxious to say, okay, we've been through some pain, now's the time to buy the dip and look forward to the next bull market. But we think if you take a long view of history, that suggests a bit of caution. Normally, when speculative bubbles inflate to extreme levels, it takes a pretty substantial amount of pain and a pretty substantial amount of time for them to unwind. So let's walk through some examples. We're going to start in the mid-1960s. You had the Tronics bubble. Now, this is any company with the word Tronics in its company name saw its share price bid up. Now, that did really well. That dragged the market higher for a few years until the market crashed by 20%. Just as the market was recovering from that, you had the conglomerate bubble. Now, at that time, it was very in vogue for companies to build these diffuse corporate empires through mergers and acquisitions, often using a lot of debt to do it, often having businesses in totally unrelated industries. That was successful. That was smiled upon for a while until the market crashed by 32%, and that bubble popped. Just as the market was recovering from that, you had the Nifty 50. Now, this is the idea that if you just own these 50 high quality businesses, Coca-Cola, Xerox, Eastman Kodak, If you just own these 50 high quality businesses, they're one decision stocks. You decide to buy them and you never need to think about them again. You certainly don't need to think about trivialities like valuation. While the next few years showed that valuation always matters, the Nifty 50 crashed, bringing the market down by half. Fast forward to the dot-com bubble. Any company with .com in its name saw its share price rocket. Some companies saw their shares increase just for having ticker symbols that were similar to the ticker symbols of popular stocks. That went completely crazy through March 2000, and then the tech bubble burst as well, bringing the market down by 47%. Global financial crisis, slightly different story, right? Slightly different story, because this time it wasn't the sexy, high growth, speculative growth stocks that led the market. It was financials, which had found a way to make themselves sexy by underwriting lots and lots of highly levered, highly debt-heavy real estate instruments. We all know how that story ended. The banks collapsed, bringing the market down by over half. And if we want to stack up the everything bubble, if we want to look at the bubble culminating in 2021 versus these prior historical periods, I think it's important to look at a measure of valuation, not just price. And I could have picked really any measure here. They would all tell you the same story. The one I've chosen, you may have heard referred to as the Buffett indicator. So this is the total market value of the stock market divided by GDP. So what we're asking is, how richly valued are stocks versus the size of the economy? And you can see at the peak in 2021, it had never been more expensive. Stocks had never been more richly valued. The everything bubble was more extreme than any in living memory that had preceded it. And you can see at the very right side of the chart in 2022, that's come back a little bit, right? But only a bit. And if we take a long view of history, it's clear that valuations today in aggregate remain at very extreme levels, more extreme than the Nifty 50, more extreme than the tech bubble, more extreme than the eve of the global financial crisis. And that worries us a bit, because if we say, hey, the everything bubble 2021 was the most extreme in valuation terms in living memory, what are the chances that it's going to unwind with less pain and in less time than any of the broad cyclical bubbles that preceded it? You know, we think that's pretty unlikely. Just for context here, when the tech bubble burst in 2000, and this is the light blue line, it took 35 months for the market to properly bottom and start to recover again. So you're looking at 3 years. With the collapse of the everything bubble, we're about 1 year in, and so we would remain pretty cautious about taking on passive exposure to world stock markets. So why look at history at all, right? What relevance does something from the 60s have to today? Well, I think if you take a long view of history and you stack up examples, you can begin to infer things that are common to each one. And if you start to do that, you can get an idea of how market cycles work. If you have an idea of how market cycles work, we think that leaves you better positioned to assess where we are today and where we might be heading. So let's start with just a very simple model of a market cycle. You have conditions of loose money. So we mean interest rates are low, bond yields are low, there's lots of money flying around the economy. Happy days, right? Loose money leads asset prices to rise. Loose money is good for asset prices, good for the stock market. And just to put some numbers on this, you know, I've stacked up here all of the money printing by the world's major central banks since the global financial crisis. You know, collectively at their peak, they'd printed something like $18 trillion since the GFC. And what I've plotted over it is just the price of world stock markets. And it's a pretty tight link, right? So when money is loose, when there's more money flying around the system, that pushes asset prices up, pushes markets up. Okay, but that eventually gives way to an environment of tight money, so higher interest rates, no longer printing new money. When in an environment of tighter money, that leads asset prices to fall, which is what we all experienced in 2020. Now, this is a really useful heuristic, right? A really useful kind of simple, rough and ready model of how cycles work, but we think it misses two really important things. The first is the cycle in valuation gaps within assets. And the second is the way that valuation gaps affect inflation in the real economy. So let's go back to the start of the cycle. Loose money, we've established, happy days for the market as a whole. Asset prices are going up, but not all prices go up by the same amount, right? Nobody writes headlines about the stock that isn't setting a new record high. And what tends to happen in these environments, say interest rates are zero, and let's say Elon Musk or a venture capitalist approaches you and they say, hey, I've got this great idea for a company. It doesn't make any money now. In fact, it burns money now, but I'm going to make $1 trillion, maybe like 10 years down the road. Now, how willing are you to wait for that potential profit in the distant future? Well, if interest rates are zero, why not wait? Why not wait? There's nothing else you can be doing to get a safe return on your cash. Why not take a punt, go for those speculative profits in the distant future? But if interest rates are 5% and that venture capitalist comes up to you, you might say, I'm not so sure. I'm not so willing to wait for potential profits in the distant future. I'm certainly not going to pay up for them as much. So when money's loose, valuation gaps widen. Companies with cash flows in the distant future tend to get bid up in price, where companies that generate more cash today tend to see their prices languish. And that's really important. And just to look through examples here, I'm going to use Chevron as an example of the sort of old economy business that gets left behind when people get excited in a bubble. We don't own Chevron, no special affinity, just a company that's been doing the same thing for a long time and has a long share price history. And in each of these bubbles, I'm going to compare the market value of Chevron to the market value of whatever was considered the new economy stock at the time. So if we roll back to the Nifty 50, one of the Nifty 50's esteemed members was Xerox. And at the time, Xerox wasn't just a copier company. It was actually an R&D powerhouse. It had innovations stolen by both Microsoft and Apple. So, pretty good cred. At the peak of the Nifty 50 bubble, Xerox was valued at 2 times as much as Chevron. Fast forward a few years, Xerox is valued at just 30% as much as Chevron. So it's not just that the bubble dragged all asset prices up. Those valuation gaps got really wide. They got totally out of sync with company fundamentals, and Xerox and Chevron had very different experiences as the bubble burst. Go to the tech bubble. At the peak of the tech bubble, Cisco was the most valuable company in the world. Everybody's excited about the expansion of the internet, all the network switching infrastructure that Cisco is going to provide, the rollout of this fancy new technology called fiber optic cables, which maybe one day will make it to my street in London. At the peak of the tech bubble, Cisco was valued at 10 times as much as Chevron. Fast forward just 2 years, Cisco is valued as about the same as Chevron. So those valuation gaps got really wide. Cisco's valuation had nothing to do with its fundamentals, and Cisco and Chevron had very different experiences when the bubble burst. Finally, let's look at the recent everything bubble. Now, there's really no shortage of ridiculous assets I could have picked here to represent the new economy. I've picked Zoom. I don't particularly like Zoom. I don't know about you, but if I have to do one more pub quiz or one more murder mystery on Zoom ever again, I want to play the victim in the murder mystery, right? That's how I feel about Zoom. But it is a real business, right? Generates lots of revenue, generates very healthy operating profits. Zoom's a real company. At the peak of the lockdown hysteria in 2020, Zoom was valued at 80% as much as Chevron. Fast forward just 2 years, Zoom's valued at 5% as much as Chevron. So it's not just that we were in a bubble that made everything go up in price. The valuation gaps got really wide and had a profound difference on the experience of stocks in different sectors as the bubble unwound. Now, the important thing here, it's not just that valuation gaps widen and close, and that's great if you're in a certain stock or not. That has an effect on the real economy. And that's kind of the reverse from what we're used to thinking. Normally, we think that markets reflect the real economy. What's going on in the economy influences markets. There are also times where markets influence the real world. And hopefully this will be instructive or at least a little bit fun. I think it's a useful illustration here to consider a really extreme, really simple case. So let's go way back in time. Let's say we're in ancient Greece and we've got a small farming village. And this village has had a better harvest than usual. So they have more money than usual and they're all feeling pretty good. They're feeling pretty flush. They gather the town elders around the table to decide what should we do with this money. And one of the farmers stands up and she's in her toga. She says, hey guys, I know what we should do. Let's build a watermill. Because right now we're milling all of our grain by hand and using donkeys. It's really inefficient. Sometimes we don't get through all of it. We have to go to the market one town over, pay them to do it. Let's build a watermill. You know, by this time next harvest, it'll be making money and it's going to make our production more efficient. And there's some murmurs around the table. You know, people think that sounds pretty reasonable. And then the oracle from the Temple of Hermes walks in. And the oracle's wearing, you know, he's got one of those Silicon Valley beards, tight black t-shirt, you know, jeans, the white sneakers. And the oracle says, hey, you know, if you want to get a little bit more efficient at making grain, you know, go nuts, build your watermill. That sounds awesome. I love that for you. But if you give me that money, well, I'll sacrifice it to Hermes. And Hermes, being the patron god of merchants and wealth, will rain down profits upon your village for generations to come. You know, by the next time you have to drive to that market town, you're going to be driving in a Lamborghini, right? By the time this thing is over, you're going to be doing all of your shopping at the Temple of Hermes, right? You catch my drift? And he gives this to the elders. Now, keep in mind, the elders are in a bubble mindset, right? The elders are feeling flush. They're not worried about getting a little bit more efficient at making grain. They want to get richer faster. So what do? Of course, they give the gold to the oracle. Oracle says, thank you very much, takes the gold, melts it down in a sacrifice in front of the statue of Hermes, and the melted gold just runs into the sea. Now, what are the implications of this for the town? Now, obviously, it's bad for investors, right? They've just lost all of their gold. It's melted, it's in the sea. They're not getting it back. But it's really bad for the town's economy as well. Because they devoted capital to a wasteful place rather than a useful place, well, all their people and pack animals are still tied up, you know, milling grain. And really importantly, building that watermill would have made their food production more efficient and lower cost. It would have brought down food prices. It would have lowered inflation. And by diverting capital to a wasteful place instead of a useful place, the town now has an inflation problem on its hands. Now, in the real world, we know we're not talking about temples and sacrifices and watermills, but it might be the difference between throwing billions of dollars at the metaverse versus investing in energy or infrastructure or food production. So when bubbles inflate, valuation gaps get wide, that attracts all of the capital to the exciting new places, which are often wasteful. It sucks capital out of the old boring places, which are often useful. That leads to shortages of things we really need, which drives up their price. And when consumer prices go up, that's the definition of inflation. When inflation goes up, as the other speakers have mentioned, central banks respond by raising interest rates. So valuation gaps widen, money's attracted towards speculative, wasteful places. You get shortages of important stuff that drives inflation, which prompts central banks to tighten money. Now that leads asset prices broadly to fall, right? As we saw as those opening charts about 2022. But it also leads valuation gaps to close. And if you're in assets that are on the right side, the value side of those valuation gaps, this part of the cycle doesn't need to be painful for you. In fact, assets trading at attractive valuations can generate pretty healthy returns even through this down part of the cycle. To put some numbers on that, let's go back to the 4 bubble periods I mentioned, right? The 60s leading up to the Nifty 50, the tech bubble in 2000, the financial crisis, and then the everything bubble culminating in 2021. Now on the left, you can see the experience of owning the expensive stocks in the market. If you own the expensive stocks in the market when these bubbles burst, you did not have a good time, right? You lost a lot of money. But valuation gaps closing made a big difference. So on the right, I have the relative return of the cheap stocks versus the expensive stocks. In the 60s and 70s, just holding your nose and buying the cheap stocks would have left you 65% better off than owning the expensive stuff. In the tech bubble, owning the cheap stocks would have left you with 180% more money than being in the expensive stuff. Different story in the global financial crisis because that was banks rather than speculative growth. And again, in the everything bubble in 2022, simply owning the cheap stocks would have left you 20% better off than owning the expensive stocks as those valuation gaps closed. So where does that leave us? Well, if I've been talking a lot about valuation gaps, and I thought a nice place to leave you would just be to take stock of where these valuation gaps are today. So there's a few things going on with this chart, so I'll take a beat to explain it. Now, this chart just plots the difference, the gap in expected return between the cheap stocks in the market and the expensive stocks in the market. When the line is low, it means the cheap stocks are only a little bit cheaper than the expensive stocks. When the line is high, it means the cheap stocks are much cheaper than the expensive stocks, and it's a good time to go hunting for value. And we can see over the 10 years following the global financial crisis, when central banks were printing $18 trillion of new money, these valuation gaps just got wider and wider and wider and wider. People became more and more focused on speculative growth and paid sillier and sillier prices for it. In 2021, this got to records. We had never seen it so extreme in over 30 years of history. And you can see at the very right, same as the stock market to GDP chart, that did come back a little bit over the last few years, but only a bit. And if we focus on the last 3 decades rather than the last 3 years, it's clear that today valuation gaps remain extraordinarily wide in historical context, wider than the prelude to the global financial crisis, wider than the tech bubble in 2000. That tells us that the opportunity to add value by picking stocks in the cheaper part of the market remains unusually good. So that's where we are. Prices now are more reasonable than they were in 2021. There's no way around that. But equity valuations are still high in aggregate, and the valuation gap within equities remains extremely wide. Looking at historical bubbles suggests that this could take years to fully unwind, but the good news is, with valuation gaps as wide as they are today, cheap assets still offer healthy return potential. And that's all I've got. All that remains for me to do is thank you very much for your time and to urge you, if you were debating what to do with the fruits of your harvest, please do consider building a watermill rather than donating to the Oracle. Thank you very much.